Good morning, and thank you for joining myself and Vince Bruno Forte, my partner in crime this morning, for this quarter's edition of WealthPoint's WP90X, 90 Minutes of Extraordinary Education. This morning, we're going to go through best practices and standards of insurance portfolio due care. Might not be the sexiest subject on the planet, but we're going to do our best as insurance nerds to make this entertaining and, most importantly, enjoyable and informative for you. In terms of our learning objectives, we're going to go through the different types of life insurance, post-issue due care, review the day-to-day. First, there's day-to-day ongoing policy service, annual reviews, which we find out aren't done so often these days. Every 5 years, it's a good idea to do a comprehensive review and market study, and we'll talk about how that provides fiduciary liability relief for corporate or trust fiduciaries, and insurance exit analyses. Also, we're going to understand the importance of life insurance policy post-issue due care, because it's really simply not a set it and forget it type of asset. What we find is that because of our compensation motivates or mitigates behavior. Our compensation in the industry tends to be very heaped in nature, so very, very large compensation in the first year, very small compensation years 2 and beyond. And so it tends to incent an industry of hunters, not service people. Doesn't mean that that's a blanket statement across the board, but it does motivate the behavior of the individuals that are selling insurance. So it's important to work with a firm that invests in process, procedure, but most importantly, people, to keep those promises as we go forward. We're going to review some case studies, and then we'll go through a conclusion and some questions. A few housekeeping items before we get started. Please type your questions in the Q&A feature in your Zoom toolbar. Please do not use the chat function. Also, due to compliance and regulatory reasons, and in order for us to offer CE, we have to maintain asking at least three polling questions. So please pay attention. We will post these polling questions via Zoom, and they will be posted for 60 minutes so you can record your answer. It's not a test, but we need to confirm that you are in fact in attendance. And then lastly, if you're interested in receiving CE or CFP credit for attending this webinar, please look for and complete the survey that's going to be sent to you. Once that's been completed and we've received it, CE certificates will be emailed to you within 30 days after the webinar is completed. And for any questions about CE or CBE, please don't hesitate to reach out to Kristen, who's our Director of Communications. It's Kristen at wealthpoint.net. First, we're going to go through life insurance policy due care. So really, what is policy due care? Again, we talked about that ongoing policy, day-to-day service, annual policy reviews, 5-year comprehensive reviews and market studies, and an insurance exit analysis. And an exit analysis is simply when somebody is making a major modification to a portfolio, whether that be deciding to keep or quit or deciding to make a major change to the policy. There are things that need to be looked at, and we'll cover those later on in the session. Why is policy due care important? Well, life insurance policies are built on a mountain of financial assumptions, projections, depend on financial markets, and the only uncertainty that we can, or the certainty that we can rely on, is change. Second, life insurance purchases really require thorough and proactive attention, and if it's not properly cared for, it can become very, very costly. So it's important to do this frequently throughout the life of a policy, so those small mistakes or small issues with portfolios don't become big ones by compounding and just procrastinating and letting things go for a long period of time. And 5-year comprehensive reviews and market studies really are they result in one of three outcomes, and they're all good. And it's a good idea to do this with any policy that you have or your clients have put in place, because it's either going to verify that the policy is performing exactly the way it was intended to. The individual or professional performing the 5-year comprehensive review and market study can identify solutions or enhancements to correct concerns with the existing policy without making any changes before they become big problems. Or there's a possibility to uncover more efficient solutions that are available in the marketplace. Life insurance, the factors that we need to look at in a review that influence the policy and planning are ownership and strategy or structure, the financial strength of the insurance carrier itself. Is the carrier performing poorly? Is it performing great? We need to know the strength of the carrier, because these are nothing but promises, long-term promises, and we need to make sure that the company or the underlying carrier has the financial wherewithal to keep those promises over an extended period of time. We need to look at the original assumptions versus actual policy experience and performance. We have a saying in our office, the only thing that life insurance illustrations prove is that paper can hold ink. So we need to make sure that we monitor and maintain these contracts and make sure that we've got reasonable assumptions or conservative assumptions, so we can deliver either news that it's performing as expected or potentially better news. And that's what we aim to do. The interest rate environment has a huge impact on the performance of life insurance contracts. Changes to policy or product pricing and the features and availability of those features in the marketplace can have an impact. Changes in health of the insured, or sometimes even changes in views of the health of the insured by the insurance industry. And we'll go through some examples of that. There may be changes in planning objectives or just updated personal financials. Where are you or where is your client at relative to where they were 5, 10, 15 years ago when they purchased the original portfolio itself? So right now it is time for polling question number 1. Vince is going to put that polling question up on the screen for you, and you can go ahead and answer that whenever you are available. So I'm going to turn it over to Vince to go through our first sample annual review.
I see the polling question still up here, Ryan, so should I give it a minute and wait for...
No, just minimize it and you can stop it when it's necessary.
Sure. So the annual review, as Ryan said, it's performed annually, and it's typically going to be following the policy anniversary. So if the policy has an annual premium, once that annual premium has been paid, or a mechanism to see if it has not, and there needs to be a reminder. It's going to be a summarization of the current policy statements and values, as well as in-force illustrations. And we want to evaluate the policy's performance and then benchmark it against the original plan. And that's crucial because we want to always make sure that it's tracking, or understand if it's not tracking, why that might be. We'll then look at market alternatives or planning changes as needed. And then we want to communicate this with all stakeholders. So that may be the client, it may be children, it may be closely trusted advisors, whoever the clients feel should be a part of that process. And lastly, it may remedy fiduciary liability concerns. And as Ryan alluded to, if these are owned inside of a trust, it's crucial that the trustee demands this review be done so that they know that things are performing as they should.
One of the things that we've heard from several people is that the current policy statements are very confusing and really don't tell them a lot about the overall performance and the long-term outlook, and it's absolutely true. one of our advisors described them as a bunch of information without meaning to them. And so it's important to have this information summarized in a digestible format where you can actually understand what the policy is doing and what's needed in terms of action on a go forward basis, if any.
So this is a sample of a review here. And so the front page is summary of the existing policies. So showing the carrier, the insured, the current values, and then below any notes necessary here. So in this case, you'll see on the next page, a premium was paid 1 year later. This is an overall summary. So on the top left, we'll show the ownership structure, the beneficiary, the carrier, the initial amount. Further down, you'll see premiums paid. This is just all the crucial basic information that is not found in those statements that get sent out. Or if you do have some of it there, it's just tough to understand unless it's laid out simply. On the right-hand side, showing the change in the values and what affects the changes in those cash values, the policy's performance, premiums, have they been paid as planned? Have there been any changes to those? Recommendations and next steps as well. In this particular case, this was a review of an indexed universal life policy. So what we're showing here is a list of all the matured segments. In this case, they were 12-month segments. So you can see the matured segments as well as the current open segments. And what we'll talk about here with
the current segments are at the bottom, the open segments are on top, and those are the ones that have not matured yet.
Correct, yes. And so what we'll show here is any changes in cap rates or any changes in the overall performance, and we can see exactly how the policy's performance is calculated and how the credits are working towards this. Want to go to the next page. And so this is a summary of an in-force ledger. So on the left-hand side is the original plan design. So when the client put this plan in place, what was it supposed to look like based on various assumptions at that time? And then on the right-hand side is a current in-force illustration. So in the light gray over in the top, you'll see what the actual premiums paid were. In this case, the design was for $1 million in year 1 and $656,000 in year 2. But in reality, the client paid the year 2 premium in year 3. So we understand that that's going to have some sort of an impact to the overall policy performance. And we want to show that so that way they can understand what the go forward looks like. And if we do ever have changes in the design, we want to be able to reflect that here. But it's crucial each year that we're able to look back and see, okay, what did we initially structure this policy to do, and how is it doing in comparison to that?
And in this case, the client and their advisors wanted to assume a much more conservative rate of return. Even though we could have run this policy at a much higher rate, they chose to use assumed rate of return of 4.8. If we ran this at 5 or better, it would go well beyond where it's lapsing currently in year 50, or the younger insured's age 104. But again, that's why we assumed that, or recommended, that there is no action, because such conservative assumptions were being used on the front end of this. There was no action required. Next, we're going to go through a sample 5-year review and market study. And this review process really was born out of a good friend of mine who was the CPA in charge of a PFP practice, or high net worth client practice, inside of a CPA firm. And I talked to him about doing portfolio reviews because he had shared with me that he had been, quote, duped into being the trustee by some clients who were also very good friends of his. And again, he said, you know, I get statements, but I have no idea what these statements mean, or whether or not the policy is performing as planned, or there's anything that I need to do. And he said, moreover, when I get approached by insurance professionals, it seems to be, let me review it. So let me see what you have and let me see if I can beat it type of mentality. All the compensation was really generated only based on if there was an alternative design, or it was a replacement opportunity. And he said, that doesn't make me feel all warm and fuzzy inside. I want an independent review. And so these reviews are generally done on a fee basis when we're doing them for an outside third party, but we do these every 5 years on our portfolio on a regular basis. And again, they should be done every 5 years. It's really a comprehensive policy review and then extensive market study. So what we want to do is we want to look at all of the factors that we can exercise. And that was one of my friend's comments. He goes, is there anything that you can do to improve a policy without replacing it? And I said, sure. And he said, well, can you give me some examples? And I said, he had a stack of 6 folders on his desk that he wanted to review with me. And the first one we picked up and we took a look, and it was rated. It was a table C or a table D rating. And we looked back in the application and saw that the client who had purchased the policy probably 15 years ago now had obstructive sleep apnea. And I said, well, this is a really good example. We can potentially go back to the carrier because back then, sleep apnea was really looked at as the scarlet letter A. It was a problem for most carriers, and left untreated could be potentially deadly or cause heart conditions. But currently, with the new technology and CPAP devices, and the cellular technology that allows doctors to monitor the usage and compliance of these treatments on a regular basis. We've had clients get rated as high as preferred or even super preferred on a few occasions if they're CPAP compliant. And I talked to them about that and said, we could potentially get this re-rated with the same carrier at a better rating, standard or better. He said, well, why would a carrier do that? And I said, simple. If they don't do that, then people vote with their feet. They go somewhere else where they can get a better rating. And the fallout or negative aspect of that is they get stuck with what's called adverse selection. They get stuck with the people that are unhealthy. And so they always want to, especially people that are taking care of their health, they want to maintain those clients. He said, is there another example? And I said, sure. I said, if a new product has been issued by the same carrier, then we can do what's called an internal exchange. And he said, what's that? And I said, well, there's surrender charges on this existing contract. If the same carrier has a better contract available, so long as the agent is willing to waive any and all commissions on the front side, then they'll waive the surrender charges, and 100% of the cash value, the account value, not the surrender value, the full account value, will be migrated into the new product. And he said, no commissions? And I said, no. And he goes, no wonder I haven't heard of that. But these are just a few examples. But again, we need to reconfirm planning objectives, obtain updated analysis of underwriting offers based on their current health. Again, just collecting current medical records for the past 2 to 5 years. And in some cases, we go out and take a look at getting market studies. We may have significant changes in health, and the policy may have been designed to last to a extended age. And in some cases, we recommend actually pulling back the funding because death may be imminent in the next 3 to 5 years. We want to create that credible baseline. Again, those things that I talked about earlier, going back and doing getting a reconsideration of the health rating, looking at internal exchanges. What we want to do is we want to create a credible baseline, put as much lipstick on the pig, so to speak, as we can, because if we just compare it to the highly rated policy and the inefficient policy, not the new policy that might be available with that same carrier, then it may be very easy to beat in a market study. But let's make the incumbent policy as good as we possibly can before we go out and do a comparison to the market. And most importantly, what this study can provide is some fiduciary liability relief for both trust and corporate fiduciaries, or for you in the audience that are looking or seeking to act in a fiduciary capacity with your clients, it's just good to recommend this for the client or the owner of the policy, which often is the third party, a trustee, just to provide them with that relief. Because as my friend said, you know, if I don't do this and the beneficiaries become aware of this problem, they become angry. And he said, I have another name for angry beneficiaries, and they're plaintiffs, and I want to avoid that at all costs. So this is an example of a policy that we reviewed. It's a $6 million policy that was issued in 2008, and the client really wanted to fund this only to age 90, and the total premiums that were being paid were $112,000 a year. The original crediting rate on the policy was 5.4%, but it had reduced since then. But he was actually still okay with it because original policy design was going out to his age 83. He had a belief because of family history, no male had lived in his family on either side. His father or his mom's side of the family past the age of 76. And so he thought that age 90 was fine, even though you'll see, disagree with him, but he ultimately made the decision to stick with the age 90 design. But his belief was that he only needed it to age 90, and there were other planning aspects that caused him to think that if it, God forbid, I live beyond age 90, I'll be a very happy man, but I'm not going to need this. But to us, it seems foolish to spend hundreds of thousands of dollars, if not in most cases millions of dollars in premiums for a zero return, because if the insurance policy dies before you do, there's nothing. So again, because of the drop in the crediting rate, the duration of the coverage was only going to age 90. We also do a blending analysis. Some policies allow for blending, which is the dialing down of compensation. In this case, the policy was it was almost no blend. It might as well have been 100% or all base or all commissionable, which is the highest cost. And so we like to get things down here on the lower end of the spectrum to bring down the cost of insurance or the cost of acquisition of that life insurance policy. We looked at the carrier's ratings, and at that time, John Hancock's rating was a 92. That's the percentile in their peer group and very highly rated. From an underwriting risk classification, he got issued at a standard non-tobacco. And we went through and did informal underwriting and went out to many carriers. And we received a lot of preferred or super preferred offers, and including we got John Hancock, the incumbent carrier, to match the other offers that were available because we had quite a few preferred best or super preferred offers, best available rate class. And so just right out of the chute, we know that just with the existing policy, we can reduce the cost, but there were more things that we could look at with this policy. In terms of life expectancy analysis, based on the fact that he got so many super preferred ratings, we looked at his probability of survival at various ages. And really, based on our analysis, if it's desired for the policy to be kept in force until the client dies, we want to go out to where there's a 95% probability of death or only a 5% probability of survival. And in this case, for this client, it would be age 105. And we can see his 50-50 or his life expectancy is actually age 92. So funding the policy only to age 90 is like going to Vegas and putting all your money on black and just hoping you're right. It's only a 50, it's not roulette, it's not even a 50-50 proposition, but you get the point. So when we went through the analysis itself, this is the incumbent policy on top at a standard non-tobacco. Annual premium is $112,000. By doing an internal exchange with John Hancock and getting the rating reduction, we're able to reduce that cost down from $112,000 to $81,000. So that's a $31,000 annual savings just by doing the work and looking at the option. If we just, what I talked about earlier, if we just compared to 112,000, that's easy for us to go out. You'll see in terms of the other options that were available. These you can see that these are variable policies, but we had them allocated 100% to the fixed account. We had Nationwide that was available, just under 74,000, and just under 60,000 was Pac Life. If we wanted to carry this policy all the way out to age 105, making sure that it stays in force, actually the incumbent policy or the internal exchange made the most sense. The Pac Life policy had some pretty high late duration mortality charges. And so it went from being the best option if we only funded it until age 90 to the worst option if in terms of the three that we looked at, if we funded it all the way out to age 105. But as I mentioned, the client was adamant that he was going to stick to his guns and make sure that he only kept the policy until age 90 because he felt like his probability of survival past that was slim and none. And he said Slim's probably not going to be in town. We still beg to differ with him. This is just the actual ledgers itself, just showing the policies. Again, the incumbent policy on the left, and then the three options available to him on the right. And again, in this case, the client chose to go with Pac Life. The Pac Life option was the most efficient. We also did some stress testing in terms of the crediting rates. So we dropped the crediting rates by 25 and 50 basis points to see how interest sensitive each one of the contracts were, because we need to make sure that the policy is going to be good, not just in the current interest rate environment, but future. These were the options that I alluded to. If we were to carry the policy out to age 105, the best option for him was going to be the policy with John Hancock, the internal exchange, at the better underwriting offer. And even with that example, we're well less than the original 112,000 that he was paying, but now he has a policy that's going to last all the way to age 105.
So this is the exit analysis here, and this was something that we had created because conversations and questions would come to us from our advisor partners and from clients when they felt that either there was no longer a need for their insurance, either all of it or a part of it, and they were looking to make some changes. We wanted to make sure that every avenue was explored before a permanent decision was made. And if a permanent decision is made, you can't ever undo it unless you go through full new medical underwriting. And this was quite a common question over the last 5 years or so. So we created this review, and that way we could show everybody what the options that exist. Far more options exist than many people realize. There's somewhere in the area of $65 billion of life insurance that gets surrendered every year, and quite a few of those do not understand the other alternatives. So there's some options to consider here. They're on that second bullet. We'll go through these over the next few slides. Staying the course, which is just continuing the way it is, a policy restructure, replacing the policy, doing a cost basis recovery strategy, a premium holiday, death benefit reduction, life settlement, reduced paid up, and a couple other strategies, surrendering for the cash value or gifting to charity. Each option has a variety of underlying alternatives within it. And so working with the creative and a collaborative team to create incredibly powerful solutions is the right way to approach this. And that's going to be looking at the estate tax, income tax, and experts with the insurance knowledge as well. So with that, we have polling question number 2. If you want to go back there. So we'll go ahead and launch polling question number 2. And here we go. So please take a minute and answer this polling question. give it just a minute here, and then
You can go ahead, Vince, and Kristen will pull it down.
perfect. So the first option here is staying the course, and that means exactly that. Just continue with the original plan and the original design, take in consideration any changes in policy performance that may decide to change the future assumptions on the performance or the interest rates. But for the most part, it's going to be sticking with what you currently have. So in this case, we had a client with a $15 million Prudential variable life insurance policy. It was issued in 2007. Originally, it had the assumption of an 8.7% gross rate of return, which would require annual premiums of $199,000. When we evaluated it years later, we decided a more conservative 7% gross rate of return would be appropriate, and found that with that assumption, the policy would lapse at age 94, or a premium increase to $268,000 would be needed to continue to the original duration. The client's health had declined since the policy was issued, and that's always something to be aware of. It was originally designed with the client having had a preferred best rating, which is the best underwriting rating you can get. But recently, the client was underwritten at a table B, so a substandard rating. That changed the life expectancy from 92 to 87. And we want to make sure, again, that we have a 95% probability of survival, which in this case would be age 99. And then the next page. And so this is a demonstration of that. On the far left side, you can see that current in force. So this was the original design, assuming an 8.7% gross rate of return, which is 7.89 net. It's got a design of $199,000 a year, and that would keep the policy in force all the way to the client's age 120. With variable policies, we like to look at them designed all the way out to age 120 because we understand there's market risk. Having that conservative cushion towards the end there would allow for the policy still to be enforced even with underperformance. In the middle design here, we just changed the future assumption from 8.7 to 7% gross. We can see the policy is now designed to age 94. In this particular case, that was still beyond the client's new life expectancy with the new medical information that we had. But if we wanted to extend it to the original duration and we wanted to assume that lower 7% return, an increase in premium to $268,000 a year would be necessary.
And you'll see that the premiums are stopping at age 100, and the reason for that is that the policy charges on this contract stopped at age 100. And so long as we have enough dollar of cash value at age 100 with this contract, it stays in force for the duration. And so increasing the premium to 268 was necessary to keep the existing policy in force all the way through age 100.
Option number 2 is a policy restructure. So this is similar to what Ryan had mentioned in the 5-year review that we do. And it's identifying ways to restructure the existing policy to become more efficient without going to a new carrier or incurring new sales charges. So that can be done via rating improvements, going through the medical underwriting and achieving a better underwriting rating. And there's a variety of reasons, as Ryan mentioned, why a client would be able to achieve an improvement in their underwriting rating. The better rating means lower insurance charges going forward, which means lower premium. The other option,
just real quick, Vince, just to expand on that a little bit, I think it's really important for those that are listening to understand when we go through medical underwriting, when doing something like this, a 5-year review or looking at a policy restructure, it's important not just to go to the incumbent carrier. We need to create a competitive bidding process and go out to multiple carriers. And oftentimes, one carrier will see the insured differently than the incumbent carrier. You can find out what they're using in terms of why they have underwritten the client at a preferred or a super preferred offer. And you can go back to the incumbent carrier and help them to get to the right underwriting risk classification. Again, replacement is not the only option when we're looking at doing a restructure. You can always look at the incumbent carrier. Sorry.
That's a great point. And it's upon the insurance advisor to act as their representative, sort of in the court of medical insurance, and providing all the relevant information needed to get that best underwriting rating that you can. So with the internal 1035 exchange, that was the transferring within the same carrier from maybe an older, less efficient product to a newer, more efficient product, if the insurance advisor is willing to waive their commission. And then also able to blend it as well and reduce the overall charges of the policy. So in this case, we have that example that we were looking at earlier, a client with a $6 million John Hancock policy, and looking at the original design and the ways that we can improve that policy. And again, similar to what you saw before, with the improvement to just the existing design within the same carrier, we can go from 112,000 a year in premium down to 81,000 a year. So saving 30,000 a year, 31,000 a year in premium without changing companies or incurring new sales charges or anything.
Again, that the old policy, by maintaining the status quo, is 37% more expensive than just doing an internal exchange and getting a better underwriting offer with the same carrier.
Exactly. Third option here is replacing the policy. So if you establish that credible baseline, that new credible baseline, and then you perform a market analysis, what you can find is the ability to replace the policy if you've proven it is actually better for the client and their new objectives. So in this particular case, we had a client age 49, has 2 whole life policies with $2 million of coverage. They were issued with Northwestern Mutual. The premiums required were $39,000, which reduced down to about $38,000 in year 17, and then again to $19,000. And the client was willing to look at alternative options and alternative products that had a different risk associated with them. They were not committed to just sticking with the whole life type of a product. So we looked at a John Hancock option, issue with a $5.6 million death benefit for the exact same premium structure. So you have a 181% increase in the death benefit right at issue and a 40% increase at life expectancy.
Real quick, we had a question from the audience. And again, just as a reminder, please feel free to ask questions in the Q&A function on your Zoom toolbar. And the question was, do you have much leverage if the client's health has dramatically declined since the policy originated? And the answer is potentially. It just depends on how we go about representing the client in the quote unquote court of insurance, if you will. But we're really at the mercy of the market in terms of how the insurance carriers are going to view that client. If it's a dramatic decline in health, then the answer would be no. But sometimes we're able to go in and really interview the client, understand their life and lifestyle, exercise habits, community engagement. There are a lot of things that carriers use, which are called lifestyle credits, that are often left out of a medical file, that the agent or the representative for the client can mine out of them by doing a thorough client interview. Because what we want to do is not just collect medical records, get an exam, throw the file before the judge and hope they're fair. What we want to do is audit those medical records. We want to look for outdated diagnoses, maybe prescriptions that were never filled. There's all kinds of things that are in there that are really designed to cover the doctor's backside because we're in such a litigious environment. What we want to do is get a clear view of the medical records, audit those, identify the issues, do a client interview, get their view of their health and their understanding of where things are at. And in some cases, go back to the physician and do what we call a challenge letter, because there are things that may be corrected via a physician's letter of clarification. They won't change records often for legal reasons, but a lot of times they'll write a letter of clarification to remove or explain things that are in the medical records. we put together a very well-crafted cover letter that includes all of those lifestyle things that are not published by the carriers that can potentially take somebody from a table rating to a standard rating. And yes, there are situations where we're able to get a better underwriting offer. So thank you for asking the question, and we'll continue to monitor those as we go forward.
And so here's that example. If we match the premiums and we consider alternative products at every other company, do we identify an option that is better? And in this case, we did. We found an option with John Hancock. This is moving to an indexed universal life product. So we go through with the team and we explain how that product operates and choose a conservative assumption for performance on a go-forward basis. And we found that we can obtain 5.6 million of death benefit. So we can see that improvement in the first year, an increase of about 3.6 million of income tax-free death benefit. And then we can see at life expectancy, the improvement still is about 1.6 million greater than the existing policy.
And again, the client was willing to take on some risks. Some of you may be looking at this and saying we're comparing apples and oranges. The client was willing to take on additional risk and requested that. And because of the nature of the relationship with our Northwestern Mutual agent, they just weren't offered any of these options at issue. And this was a few years ago when cap rates are higher. This was actually a conservative rate. This might be lower at this point in time. But the policy has performed actually quite well. This one has. So the option number 4 is cost basis recovery. And this is really a 1035 exchange of a life insurance policy into an annuity contract. It's which you get a carryover in your cost basis. And it must be a like-kind exchange, meaning the same owner and the same insured or annuitant. So if it's a single life policy, it needs to be the same insured and or annuitant and the same policy owner. And the transfer can be to any type of annuity. So that could be fixed, it could be variable, it could be private placement, it could be index, it could be an immediate income annuity. We have the full gamut of annuity options that are available. The 1035 exchange, though, can result in really a reduction or elimination of income tax on the future gains of that investment in the annuity on a go-forward basis. So all the growth up to the cost basis can be taken totally income tax-free, which is a huge benefit. And the 1035 exchange of a second life policy with a gain also could offset that tax liability. So we've had situations where we've had one policy with a big gain in it, another policy with a big loss in it. We 1035 both of those contracts into an annuity, and one gain offsets the loss, and then we're able to surrender the annuity. And in a lot of cases, we use private placement variable annuities with no upfront fees or charges or costs in order to create a situation where we can immediately surrender it if that's what we're aiming to do. And the client can enhance it because they have the ability to add funds, which adds to the basis of the new annuity contract. And in this case, we had a client. She was a female, age 63, and she had $8.5 million of insurance, which was a guaranteed policy. And she had paid $100,000 a year for a total of 10 years so far. And what had happened is because of the success of planning strategies and the increase in the exemption, they decided that they were no longer needing this $8.5 million of insurance. And so the financial advisor called us up and said, we're going to surrender this policy. What do you think? And this is what we're really looking at. Whenever a client is looking at doing a major modification to a life insurance policy, it's important that you call an insurance professional and make sure that they go through all of the different exit options based on the client's objectives. We can usually narrow it down to 2 or 3. But in this case, it was a very, very good phone call that the investment advisor had made. Again, what we would do is to do a 1035 exchange into an annuity contract. and the client would just add an additional $2 million deposit into the contract itself. So the contract had $192,000 of surrender value and a $1 million basis. Had they surrendered that contract, there would have been a loss, a non-deductible loss of almost $808,000 that would have just vanished. But because we do the 1035 exchange into the annuity, right away when we 1035 and 192,000 into the annuity, we have 192,000 with $1 million basis. So all the growth from 192 to $1 million is totally income tax free. But as you can imagine, it will take forever for that policy to grow to $1 million. And that's why we looked at the additional $2 million deposit. Once the monies are withdrawn, the policy, because of the carryover in basis, they're able to recapture that basis. So after we deposit that additional $2 million, we've got 807,000 of cost basis being recovered, which really is translated into a total income tax savings for that client of 323,000. I get excited when I find a $100 bill or a $20 bill in my winter coat pocket. Finding 323,000 is amazing for a client. If the policy was surrendered instead of exchange, again, we would have lost out on that 807, almost $808,000 non-deductible loss. So this is just showing if we took the 192 growing at 6%, it would take 29 years for our cost or our actual account value to exceed the cost basis. So we would have fully absorbed it, but it would have taken 29 years to do so. By adding an additional $2 million, so we now have a cost basis of $3 million rather than $2 million, we're able to recapture that cost basis just after year 5, in between year 5 and year 6. We're able to then just surrender the annuity if the client wants to, and reposition that tax-free cash back into the investment portfolio. Or in some cases, clients choose to hold on to it because they want to maybe earmark this as a charitable asset, and we'll have the assets growing income tax-free inside of the estate, and then ultimately left to charity. And again, in this case, it was private placement variable annuity that was used. The client already had a position in a private credit fund that was yielding a very high rate of return relative to their other assets, but all ordinary in nature. And we were able to have that return. We assumed 6% on the initial analysis. Their private credit fund was initially getting about 8.5%, 9%. Now is at around 11%, and that policy will be surrendered very, very quickly. In terms of premium holiday, due to the tax reform, some clients may just want to take a wait and see approach. You know, we don't know if we're going to need the policy or not. And so the client may just want to suspend premiums until tax reform becomes more permanent, or we have a little bit better outlook on how things will be going forward in terms of the estate tax exemption. However, if it's a guaranteed contract, it may have a negative impact. And so you want to be very careful about doing premium holidays on policies with a contractual guarantee. In this case, we had a client, male, at age 53, and he had a $4 million policy, again, a variable policy with John Hancock. The schedule of $150,000 year 1, 75 year 2, and then 27,288 years 3+, and the policy was issued in 2016, and the client was unsure if he wanted to continue funding the policy long term. And so we wanted to evaluate the impact of paying 0 premiums for 5 years and or 10 years if we wanted to, and then resume paying premiums. If we waited 5 years and paid 0 for the next 5 years, the premium would go from 27,288 up to 38,770. If we waited 10 years, then the premiums would go to 56,490 years 13+. So again, In some cases, it might make financial sense to defer the premiums. We evaluate the net present value of the internal rate of return of the future premium schedule. We also have to look at the future value of the premiums not being utilized to fund the insurance, because they will stay in the client's investment portfolio. And then again, not all policies allow for premiums to be deferred, so there may be riders or guarantees that will lapse or become severely affected if premiums are not paid. And other policies, like whole life policies, may go into what's called an automatic premium loan that will be situation where it will accrue interest, and that may also have a negative impact. And so really we need to do a thorough analysis to make sure that we evaluate the cash flow and investment return of any deferred premiums. In this case, this just is the ledgers that show the various options. This is if we just stay the course, it's 27,288. If we pay zero premiums for the next 5 years, the premium goes up to 38,770. If we pay zero premiums for the next 10 years, it goes to 56,490. Again, we don't just have to decide keep or quit. Sometimes a premium holiday may be just what the doctor ordered in order for the client to reevaluate what they want to do long term with regards to the ownership of a life insurance contract. Vince, is this one yours, or am I still doing this?
Happy to go through this one here. So this is a death benefit reduction. Reducing the death benefit in a life insurance policy is a permanent change, but it's an option that exists. So we want to make sure that we'll take a look at the total planning objectives of the client and see if this is the best route. But what we can do is reduce the death benefit, and ultimately that would reduce the insurance charges and ongoing premium need. So there are some constraints from the carrier to be aware of, but because of that benefit to the charges, it may be a viable option to consider. In this case, this client had the $15 million Prudential policy, and it was initially designed for estate liquidity back in 2007. But due to tax reform changes, they want to consider dropping some of the death benefit. So we wanted to show a few options, reducing by $2.5 million, by $5 million, and by $7.5 million. On the next slide, here's that scenario shown. So again, we started at 15 million, but if we reduce down to 12.5 million, you can see on the left what happens to that premium, going from 268 down to 197,000. Or you can see the premium at 10 million becomes 126,000. The premium at 7.5 million is 55,000 a year. So we want to evaluate really what's necessary and consider the fact of what might be needed in the future, because once you go down, you can't go back up unless you go through new medical underwriting. But if you're confident in what you need, certainly might be the best route is just reducing the death benefit.
One thing to note here is that when you look at this, it's not linear. So 268 was the cost for 15 million, and 53,000 was the cost for 7.5 million, or half of the benefit. And you may ask, why is that? And it's because of the $1.7 million of cash value that exists or continues to exist in the contract. But one thing to be mindful of when doing death benefit reductions, with some contracts, death benefit reductions can be viewed by the carrier as a partial surrender. And so in this case, there was a non-commissionable term rider that was existing on this contract, and we were able to drop that, which has no surrender charges associated with it. So you want to be mindful of having potentially a forced surrender or partial surrender of part of the contract if, in fact, it does have surrender charges on it. So that's something to be careful of.
Perfect. Yep. And that surrender would impact the cash value.
Yes.
So option 7 here is life settlement. So many of you may be aware, but there exists a large market of investment funds that will purchase life insurance policies from clients. So what they're going to do is they're going to look at the client's current policy, the design, the premium solve out to age 100 or age 105, the client's medical records. And these investment funds may decide that they're able to pay a client a lump sum today, and then the investment fund takes over paying the premiums, and then ultimately they collect the death benefit. The investment fund collects the death benefit at the client's passing. So a lot of these buyers are investment funds, banks, or institutional investors. They're going to be purchased for more than the cash surrender value. So a client who decides they don't need their policy may initially believe they just want to surrender it, but they could receive an offer that's greater than the surrender value. So life expectancy studies are going to be performed from independent life expectancy companies. And then the purchase price is going to be impacted by a variety of factors: the policy type, the product, underwriting. Tax reform was actually quite favorable for this. So what happened is it increased the client's cost basis within the policy, so that any sale proceeds that are above that cost basis may be considered long-term capital gains. There's some other nuances where a portion may be ordinary income, and we'll discuss that in a bit. So in this particular example, we had clients, the husband was age 86, the wife had passed away, but the two policies were survivorship life insurance policies, and they were owned in an irrevocable life insurance trust. So we had two policies of 2.5 million each for a total of 5 million of death benefit. The client had been making large gifts to the trust in order for the trust to pay the life insurance premiums, and the required premium was about $234,000. The client's advisor team decided that it was not financially suitable for this client to continue making such large gifts, because the client had done a lot of other planning, and ultimately the remaining assets the client had, he needed in order to pay for his lifestyle expenses. So without making those gifts to the trust would be unable to make the premium payments, and thus initially the phone call we received is the client's looking at surrendering the policy for the cash value. Are there any other options that we should look at? So we evaluated 5 options in this case. One is keeping both policies. The other is surrendering both policies and investing the proceeds, or keep both policies and reduce the death benefit. Or we could sell one policy and use those proceeds to pay the premium on the other policy, or ultimately just sell both policies and invest.
Real quick, we had a question before we go on to the results of this analysis. Are you able to reduce a policy death benefit multiple times, and what are the pros and cons? And the simple answer is yes. And the second answer is it depends. And it depends on the specific contract, the carrier, and also the policy design itself. And so I would say on a blanket, you can't really make a blanket statement on this. It just you should go through a very thorough design. And so you can request an in-force illustration, reduce in our previous example from 15 to 10 million to 7.5, and model out several death benefit reductions, and we can actually do that in the case of the policy that we had demonstrated earlier. But with some policies that may not be feasible or financially feasible to do so.
Excellent. So this graph here shows those 5 options outlined. So that red line there is keeping both policies, but stopping the premiums. In this case, that wasn't a feasible option because the policies would only last for a few more years, which was before the client's life expectancy, or the probability of a 50% probability of death. So you wouldn't want to have paid all those premiums and have less than a coin flip chance of the family receiving the benefit. The option there,
I would just also say that this client and their family, and also the financial advisor, the big driver here was, although his life expectancy was in between age 91 and 92, he was incredibly active at 86, and incredibly in tune to his health, had a long family history on top of that. And so they were betting that dad was going to live well beyond his life expectancy. He would be on the long end of the mortality curve. And so when you look at this 89% probability, they really looked at that as his 50-50 probability of survival based on, I don't want to say his name, but we'll call him John, based on John's current exercise and health habits and eating habits and how he was managing his health. So
Yeah,
so
thanks,
the
Ryan.
first option was not even close to being an option for them.
That's a great point. So when medical records are evaluated, that shows everything that's gonna be in your medical records from your doctor. But things that don't show up are your lifestyle habits. And in this case, this was a client who no longer drank. He didn't smoke. He woke up at 4 a.m. every day and walked 5 miles, and he lived an incredibly healthy lifestyle. So the family believed that although the probability of the life expectancy says age 91 or age 92, most people his age, this 86-year-old, most people aren't doing what he's doing. So he's going to be on the much later half of that mortality curve. So thanks for adding that part. So the yellow line here is selling one policy in order to fund the second policy. But again, we can see that those premiums would only keep the policy in force to age 96. And again, the family, based on all the other factors we had mentioned, factors that don't show up in a life expectancy study, felt that dad had a pretty high probability of making it to 95 or 96. And so they would rather be rooting on the side of dad living a really long time rather than being in this predicament where if dad doesn't pass away by a certain point, all money's paid or lost. The other option here is to sell both policies. Sorry, the black line there at the bottom is surrendering both policies. You wouldn't have done that in this case because we had offers on the table that were far greater than the cash surrender value. The cash surrender value was about 600 and some thousand. There was also an option of doing a reduced paid up. So dropping the death benefit down to a level where no more premiums would be required. But because of some limitations within the product itself, we were unable to drop the death benefit so far down that the policy could sustain forever on its own. There's some nuances to every product. So in that case, that was no longer an option. And then you can see that blue line there shows the option of selling both policies and then adding those funds and just investing them in a brokerage account. And ultimately, that had the greatest chance of long-term success and to put all the family in the same page of knowing dad's probably going to live a long time, and we'd rather guarantee a rate of return on this investment now by selling the policies for a gain and investing those proceeds.
And Vince, I think we had $650,000 or $660,000 of surrender value if they would have surrendered it, and our net to the client, net offer to the client was what? About $1.8 million, wasn't it?
It was about $1.6 million after tax. So we had an increase of about $1 million net after tax proceed simply by evaluating this option and not going with the initial gut instinct of the family, which is surrender the policy. And that's a perfect example. Option 8 here is reduce paid up. So one of the items that we had just mentioned, and that is reducing the death benefit down to a level to where no more premiums are going to be required. Now, again, there's nuances with every product, but due to tax reform or other changes in the planning needs, if the death benefit, the amount, if the original amount's no longer needed, but they do want to maintain some for whatever reason, then we can reduce the death benefit down to a level where it can remain in force on its own in many cases. So the policy becomes quote unquote paid up at that point in time. Again, going back to our previous example, the male age 68 with that $6 million John Hancock policy, originally designed with premiums of $26,000 a year, looking at what the option would be if we just reduced the death benefit and had no more premiums required. We can see here that $6 million death benefit would be reduced to 4.375, so 4,375,000, and we'd be able to keep the policy in force to age 100 without any further premium requirement assuming a 7% gross rate of return. Option 9 is pretty straightforward. It's surrendering for the cash value. So we've talked about this a couple times previously. This is always an option that exists, and before it becomes the first option, everything else should be considered. But ultimately, we may find that surrendering the policy for the cash value is the best outcome for the family. And this gives them freedom and flexibility to do what they want with those proceeds and invest it in alternative options. So in this case, we had a client. She was 60 years old with a $4 million nationwide policy that she no longer needed. Cost basis was $400,000. The cash surrender value was $506,000. So we have taxable gain of $106,679. So the net after tax proceeds are about $464. And remember, when you surrender a life insurance policy that has gain, the gain is going to be taxable as ordinary income. So for this client, she was in the highest tax bracket. So there's about a 40% tax associated with that surrender just on the gain. As mentioned previously too, the client could opt to 1035 it into an annuity and capture that loss cost or
there was a gain.
There was a gain there.
But they could continue to defer that gain if they didn't want to recognize it and do a 1035 exchange into an annuity.
Correct.
So Vince is going to go ahead and launch polling question 3 for everybody.
Perfect. So we'll go ahead and take a minute here to answer this question. And then we've got one last scenario or option that Ryan will discuss.
And in the polling question, I believe this is the life settlement polling question. It's asking whether or not, and I'm going to give you guys a minute to answer, but it's asking if a client needs to have a life expectancy of 5 years or less in order to be a sellable contract. And I'm going to cheat a little bit here for those of you that haven't quite answered it. And the answer to that is false. With a life settlement, it really depends on the contract, and it depends on the required premiums, which is the carrying cost of the purchasing party as they take on the responsibility of that asset. I would say as a general rule of thumb, it's somewhere around 120 to 140 months is a good general rule of thumb. So if a client has around 10 years, in terms of actuarial life expectancy, which is done by an independent third party. These life expectancy study companies are independent third parties that evaluate or value a life insurance policy for the purpose of potential purchase. And they're really looking at the life expectancy of the underlying individual, and based on their individual mortality, their actual health history and impairments, they'll estimate based on past experience of other folks with similar impairments how long that client is projected to live. And again, life expectancy by definition is just a 50-50 probability of survival. 50% of the people in a certain age and health demographic will be on the wrong side of the grass. The other 50% will still be on the right side of the grass. And so it is with life expectancy studies, it's just that, it's just a projection. What most life settlement companies are worried about are what's called tail risk. And tail risk exists, but in terms of if I've got carrying costs for this contract that I purchased, if I have to fund that policy well beyond life expectancy, what does that look like, and how does that impact the overall performance of my fund or my portfolio that I'm managing? So the last example that we're going to go through is a pretty involved example, and actually very, very interesting. And it involves making a gift to charity. And this isn't something that happens very often, but in some cases it does. So an insurance policy can be gifted to a qualifying charity, including a donor advised fund. And the policy's interpolated terminal reserve, or ITR value, will be used for determining the value of the gift to the DAF. And by definition, and we've got some information right behind these slides, where you can look at it, but it's the lesser of cost basis or ITR value, whatever the lesser value is that's deductible in terms of a charitable gift. So in the event of a premature death, the charity will receive the full death benefit, and the client can make additional gifts of the tax savings, which is what we did here, to the qualifying charity to pay premiums on an ongoing basis. So the client would receive an income tax deduction for those continued gifts. So I'm going to get tax savings, and then I'm going to use that tax savings to continue to make gifts to the charity, which then generates more tax savings. And what we end up with is a zero cost result to the client. So the client has an asset. In this case, we have a client, the husband is age 70 and the wife is age 68. And they were sold a very, very large Lincoln survivorship policy that was a guaranteed universal life policy that they really didn't need by the advisors from the advisor standpoint. It was oversold to them. But more importantly, with all of the planning, they had done several defective trust sales and some gifts, and the large defective trust sales, they were leaving the defective status on. So the clients were able to pay tax on behalf of the trust. There just wasn't a need for 30 million of additional liquidity, let alone any additional liquidity for the family group. So this policy was originally designed for estate liquidity, and the client had paid $203,000 a year for 3 years, and no premiums, though, had been paid for the last 13 years. And you might think, well, this is a guaranteed universal life. If you stop paying premiums, how is the thing still in force? Well, these policies generally have what's referred to as a shadow account, and the policy was just kind of surfing along on its shadow account, had no value, no surrender value, no nothing. But the policy, because of the $609,000 it was paid in that first 3 years, was still in force. But it was about to lapse. Within the next year, it was about to lapse. And so based on the fact that they didn't need the insurance anymore, they were looking at, what do we do with this contract? Again, the clients generate a sizable amount of taxable income on an annual basis. They were had income in excess of $1.7 million, and they were interested in increasing income tax deductions because they were California residents, and they were also charitably inclined. They would like to give back to the community. They were very heavily involved in the Jewish Community Foundation where they lived, and they wanted to do something in addition to what they were already doing. If they had the ability to do something philanthropic, they wanted to explore that. And what we would eventually do is just use the tax savings from the charitable tax deductions to fund a new policy for charity. And we looked at 3 options for the client: a no lapse guarantee, a universal life, and an index universal life. And as you can probably suspect, the charity being conservative and wanting something that was fairly certain, they were looking at the first 2. They really didn't pay attention to the last one. But what's interesting is just looking at how the tax savings works. And so we had a policy, this policy, even though it had zero value, zero cash value, when we went to the carrier to get its ITR value, or interpolated terminal reserve, was 2.381 million. And so we're able to make a gift of the policy to the charity, and it ends up generating a $2.381 million deduction. But the charity is not interested in receiving a policy that they're going to have to fund now on a regular basis. If any of you know charities, they're really looking at current donations and current cash flow. Having to invest for some future benefit is really not of interest to them. So the charity would not have just accepted this just to help their donor receive a big tax deduction, but they were interested in getting something that was effectively an endowment at the time of the donor's death. And so you can see the first gift that we make is 2.381. They had a total of $1,710,000 in in total income. So they're able to pick up a 50% deduction in the current year of $850,000 federal. And so we've got a federal carry forward of $1,526,000. So that's the difference or delta between the original value of the gift and the deduction made in the first year. So we've got $1,526,000, which saves them 316,000 in federal income tax savings. We also get a state deduction, same state carry forward, and we're able to get 113,000 in state income tax savings. So our total tax savings is $430,000. And so the clients will turn around then and gift that to the charity the next year. So their gift is $430,000. So now they've got the combination of this $1,526,000 and 430,000 that is available to deduct. Again, we're able to make another 855,000 subject to the 50% max. We've got a carry forward of $1,101,000. We save another 316 and another 113. So the client's able to gift another $430,000 the next year, and so on and so forth. And so this continues to go on until our carry forward is totally exhausted. And then you see that it starts to dwindle because our benefits of our savings. So what we're going to do is we're going to use the tax savings that the client has been able to realize on an annual basis to fund a policy for the benefit of charity. And so these were the options that I mentioned earlier. A no lapse guarantee policy, we're able to take that 430 for the first 5 years, 342, 172, and so on, and that 10-year funding, and we could buy a guaranteed contract through Nationwide at that time, just under $7 million. We could utilize a regular universal life, a protection SUL with John Hancock of $9.5 million, $9.542 million, and this would go all the way out and is illustrated not to lapse. Or we could use it to buy an IUL, but there just wasn't enough lift between a regular universal life and an index universal life, and the charity had settled that this was the best option for them. And so what we've got is we've got a situation where the client has used nothing more than the income tax savings from their gift to generate a sizable endowment effectively for charity. And it looks like we've got a question. Says after the husband dies, the wife no longer needs the policy in her life. Can she structure to have the policy pay for long-term care? It depends on the policy itself and if it has that rider. And so I would say that really depends on the individual contract. And then gifts of cash to charity to pay premiums, are they for the benefit of a gift, lower deduction, or gifts directly that qualify for the highest AGI deduction? Those will be cash gifts, and they could technically qualify for the 60% deduction. We've assumed 50% in each year in our example. And then the treatment of the policies with loans to charity, I don't think we have enough time to do that, but that's a complex situation, and we'd be happy to answer that if you'd like to set up an appointment. And again, it depends on the contract. But anytime where we've got a taxable event, just like when Vince talked about, if the policy had a gain in it and you sold it to a life settlement, you would have to recognize that gain first as ordinary income, and then the balance would be taxable as a capital asset. Same thing exists when you make a gift to a charity, and so you can't it would just wash the taxable income. You would not get a deduction for a policy with a gain in it because it would have otherwise been recognized as income by the client themselves. So, but in this case, we've got a situation where the client has, again, essentially created a $9.5 million endowment for a cause that is near and dear to their heart, with absolutely zero out-of-pocket cost to the charity. Now, the charity itself has to wait. They have to wait until their life expectancy, and if we can see here, that's going to be another 30 years. But I don't know of a charity on the planet that wouldn't like to have $9.5 million at some point in the future, and they've got a situation where there is absolutely no cost in terms of out-of-pocket costs to the donor or our client in this matter. Again, we talked about in terms of charitable disclosures, and all these materials will be available to you when we're done. Again, please look at and complete the survey if you're looking to receive CE. And we would be happy to share the presentation and or a recording of the presentation itself that Vincent and I have gone through, so you can share it with colleagues that were not able to attend if you think that it would be valuable for them to do so. So again, just a review. We've gone through the types of life insurance, post-issue due care. We've understood, hopefully, the importance of post-policy due care, discuss the factors that influence future life insurance planning, and reviewed the different types of post-issue due care. First being an annual review, so making sure that annually a portfolio or policy is being looked at and being monitored for policy performance. Every 5 years, going through a comprehensive market study, including underwriting, and looking at re-underwriting the case on a go-forward basis to make sure that we've got the best possible underwriting available for the client. But most importantly, providing that fiduciary liability relief. I can't tell you how many times that we've had clients and or advisors or just friends of the firm that have been asked to be trustees, and they think that all they have to do is just facilitate the payment of premiums and monitor crummy notices and this, that, and the other thing. But again, life insurance is just not a set it and forget it type of asset. We really need to, even with guaranteed universal life policies or guaranteed contracts, we need to monitor the performance. We need to monitor the credit quality of the insurance company, make sure that we're paying attention to the current financial markets. There are lots and lots of factors, but the last and not least is the exit analysis. If you have somebody that is looking to make a major modification, stop paying premiums for a period of time, which could be devastating on a guaranteed contract. If they're looking to quit the policy, reduce the death benefit, whatever it is, you really need to go through a thorough exit analysis in order to make sure that you're not doing something that might be harmful to the overall portfolio itself. So we'll open it up right now. We've had a few questions that I've answered live, and I've already answered this. I just had a comment. Great presentation, fellows. Very thorough and valuable insight. Thank you for the compliment. Again, if you wish to contact us, or if you have a client that has an existing portfolio, this is something that we do in terms of fee-based reviews. The friend that I had talked to you about, he wanted to pay for a review and have our sole compensation. This is something that we do on a regular basis, where we will do a fee-based review. We will recuse ourselves from offering implementing on the recommendations. They could effectively take our report and go elsewhere. We know that once we go through a very thorough analysis and they get a chance to see the type of work we do, that we may earn the right to implement on recommendations. but we absolutely will not make any attempt to influence the client or their advisors to implement, because if we do, it's not an independent and objective review. And first and foremost, if we do that, then we have it in our contract that any and all fees will be refunded back to the client because we'll be in breach of our contract. And second, we probably will never be asked to do an independent and objective review ever again. But it's something where we will do a thorough review without any expectation of implementing on any of the recommendations. But if the client or the client's advisors choose to engage us separately as their purchasing agent to perform the execution of the strategies that are implemented, that is entirely up to them. But that being said, again, for more information about WealthPoint or the other services that we have to offer, please feel free to visit our website at www.wealthpoint.net. And please be on the lookout for the survey that will be coming to you after the fact. Vince, do you have some closing comments?
I just noticed two last questions came in.
So how much does an independent review cost? I would say that depends on the complexity of the underlying policy, but generally it's anywhere from $1,500 to $2,500 for the initial policy, and an additional $750 to $1,000 for each additional contract after that. If there are additional factors that may add complexity to the analysis, like premium finance, private split dollar, whatever it may be, then there may be additional charges. But I can tell you that it is more than worth the fee. Fees usually only matter in the absence of value. But a good example, we had a portfolio of 8 policies, nearly $100 million in death benefit, and our total review cost was $12,500. And this also included a couple of policies that were premium finance. We had some portfolio reviews that have been as much as $25,000, and some that have been more in the $1,500 to $2,500 range. But that is something that we're absolutely happy to do, and it also, for us, it helps us showcase our responsibilities or our work product itself. And the next, if the donor decides not to make the gifts of tax savings, are there options mentioned available to the charity? Yeah, the charity can opt to continue funding. They could opt to do a reduced paid up or reduced death benefit. There are options, but we're wanting the contract or the client to enter into an agreement with the charity to continue to make these gifts, because again, it's something that's going to accrue to the benefit of the donor, and the charity really does not want to make ongoing premium payments. So this is an agreement that is generally made between the charity and the donor, but as most people know, these pledges are not really enforceable, but usually the clients are going to have the integrity to maintain the plan on a go-forward basis, because this is all found money. So if there's any other questions, feel free to ask. But we're going to end in the next few minutes. For those of you that want to ask any questions, please do so now. Otherwise, we will be finishing up our presentation for today. Again, thank you for joining us for this presentation. If you have any questions, feel free to reach out to us, and hopefully you were able to take away some valuable insight that allows you to advocate on behalf of your clients in a manner that you didn't or weren't able to do previously. We look forward to seeing you at our next WP90X. We'll be announcing that topic soon, and the date and the time. But again, thank you everybody for your time. We have another couple of questions. The slides will be emailed to you. Kristen in our office will be sending out an email with a link to both the slides themselves and a recording of the presentation. Again, that is for your benefit, or if you'd like to share those slides with others, other colleagues that you think might find it valuable, you can do so. Again, thank you everybody for attending. Please complete the survey and we will get CE certificates out soon. Thank you.